All right, guys, this episode, we're going to be talking about how to get venture capital investors to notice your business. So last one, we talked about angel investors. This one is on venture capital investors. What is a venture capital? It's an institutional funding for high growth businesses. So instead of a single angel investor, could be a pool of them together, could be a fund, could be another business, whatever you call it, it's there to invest in businesses. So it's not just a single person. You actually have a fund behind it, or a venture capital, which is a business in and of itself, right? And they invest in businesses. So how do VCs, short for venture capital, how do VCs differ from angel investors? Large investments for equity. So they're going to give you an investment for an equity stake in your business. And they focus on scalable startups with high ROI, so a return on investment. These are normally going to be in certain spaces. There's different positions and different types of investors and venture capital firms to do different things, right? Some venture capital firms may only be interested in the med space. Or some may just be interested in the SaaS space. So it depends. You have to do your research, you have to find the right ones, and ultimately get a market fit for you. Ultimately, VCs, what are they looking for? Market size and scalability, unique value proposition. So what makes your business different? What makes your idea and your business plan that you're executing on and that you have an intent to do, what makes that different, right? And then a strong, experienced team. I can't harp this enough. I said this in the last video. The team is vital. If you do not have a strong team, then you're going to fall apart. And if they understand that you don't have a strong team, they're not going to invest in your business. So you want to make sure that you portray that you have a strong team, but that you actually do have a strong team as well, and that you have a good market and problem fit, and ultimately many other things. And we're going to talk about those, because exactly what do you need to make your business stand out? You need data-driven pitches. So your pitch deck is going to be solid. You got to have everything in it. You need to have it based on data, right? Good hook, good story, and good ask at the end, offer. Now, it has to solve a big problem with an innovative solution. You want to make sure that these two things are followed, because if not, nobody's going to invest. They're not going to see value in your business, because the investor, they're looking at the business as, what am I going to get out of it? When am I going to get my money back? What's the return on my investment? And is this business actually going to take care of my investment? You have to think about that, because you see it as, I need the investment to grow the business, but it's actually the investor that's putting in, or the venture capital firm that's putting in. They look at it as, when am I getting my money back, and how is my money being handled? They want to make sure that these things are actively working in their favor, right? So how do you create a winning pitch deck? Problem, solution, market opportunity, traction, team, and financials. If you get these squared away, and I talked about this in the last episode, this is crucial. If you have a good defined problem, if you have a great solution for that problem, you talk about the market opportunity, what's lacking in the market, what are other people doing, things like that. What are they not doing? What's the traction? Obviously the team. We talked about team. You're going to hear that over and over. And of course, the financials. You need financial projections. You need to have your cost in line. You need to have everything ready to go so that you can answer it quickly. If you're doing a lot of ums and uhs and I don't knows, I mean, maybe one, hey, I don't have that piece of data, I will get that back to you. But if this is a reoccurring theme and you don't have your ish together, then guess what? They're going to look somewhere else. They're not going to invest in you. The elevator pitch, you got to have that on point as well. Make sure it's quick, it's in there, 1 to 2 minutes at the max. And you want to get in and get their attention. That's the biggest part of this. So how do you build relationships? You want to attend startup accelerators, incubators, and network events, pitch off events. These are things that I've been a judge at before. I've looked at these things, I've been to them. I've been involved with them in Vegas here for a bit. These are things that you want to make sure that you go to. Even if you're not ready yet, find out what the norm is. Y Combinator, other companies like this, they have these different events that you can just be involved in and you can see them. Local pitch events in your area, even if they're nothing to you, go. They actually mean something. There's a lot of these pitch events that take place and they're out there. You just have to find them. Now, what are the common mistakes, common VC mistakes to avoid? Inflated evaluations and lack of clear vision or plan. I can tell you what, VCs know the pattern. Venture capitalists and angel investors, they both know the patterns. So if you come in, and especially let's say you're in a specific space like the SaaS space, if you come in, you talk about your problem, you talk about the market opportunity, and you're inflating your evaluations, I can tell you that's the quickest way to get a VC to go, F that, I'm not looking at it. This is BS, right? So we're trying to keep it PG here, but ultimately you want to make sure that you just get the data and actually you're a little bit conservative on it, right? Because if you inflate things, it's going to come out later. It's ironic because in the loan space with commercial real estate and residential real estate, I see this all the time. You know, I was being involved with a family office here, and ultimately we saw on some of the lending side of things, we saw exactly what was going on. And I could tell you almost every application inflated cost. So, or inflated their projections. Do not inflate projections. It happens in the business world as well. So the lack of clear vision or plan. Have a defined vision, have a defined plan. 1 year, 3 year, 5 year, 10 year. What's your exit? How are you preparing for the exit? Are you preparing to go public? What do these look like and what are the timelines on these? And get granular on it. The best thing that you can do is provide more data than not enough, because it shows that you're doing your due diligence and you're not just looking for some capital to hurry up and fund your business and do whatever you want with. On the next one, we're going to be talking about what are the biggest mistakes of an entrepreneur. This is a good one, so you're going to want to tune in. I'll see you on the next.